The Rebel Capitalist Show.
I was trying to think through how the dollars are working on the balance sheet of the primary dealer banks and the commercial banks that are kind of under the Fed's umbrella. Because initially I was under the assumption that when they would settle, and I should really explain this to people, but when the banks would settle a transaction, that the assets were largely transferred in the form of bank reserves. So just to back up here so the people are following what I'm saying. So let's just say that you've got an account with Wells Fargo and your buddy has an account with Bank of America and you need to transfer him, you do a Zelle payment for $1,000. Well, those dollars that are your assets are liabilities of the commercial bank where you have an account. So if Wells Fargo transfers that $1,000 to Bank of America, or vice versa, they're transferring them $1,000 liability. Well, they can't just keep transferring them liability after liability after liability after liability, or else the other bank is insolvent. So there has to be a corresponding asset transfer that goes along with the transfer of that liability. So what is that? It can be a bank reserve, and that's a dollar in the form of a Federal Reserve liability, just like the dollars that you have in your account are a liability of a commercial bank. So that's pretty much what I was trying to think through. And what kind of sparked my idea was the fact that there are a lot of these credit unions and smaller banks, and then of course banks outside of the United States that do not have reserve accounts with the Fed. So if Wells Fargo is transferring that $1,000 liability to XYZ credit union, what is the corresponding asset if that bank doesn't have, or if that credit union doesn't have an account with the Fed to receive those bank reserves? So why don't we start with that first and foremost, and then we'll kind of go from there.
Sure. So George, you're exactly right. So when banks settle payments with each other, it's usually with reserves, so central bank money. So reserves are instantly liquid since they both have accounts at the Fed, right? So the transfer is instant and it's final. And because it's a liability of the Fed, it's risk-free. So you and I, we hold bank deposits, right? We still have bank credit risk. So
and is that what typically done through FedWire?
Yes,
that's
exactly.
FedWire. Okay.
FedWire, right. Now, the question about smaller banks, well, I think that you've touched upon a really interesting question as to what do people who don't have Fed accounts do? Now, right. Just to give you a sense of this universe, if you're a domestic bank in the US, you almost always have a Fed account, even if you're a credit union. So people who domestically who don't have Fed accounts, they're like really, really tiny banks that you wouldn't have heard of. Okay. What they do, though, they could have, let's say, they could have an account at, let's say, a bigger bank, right?
Just like a non-bank entity would.
Well, they could hold reserves. So if they're not big enough to have their own Fed account, they can hold it through like a sub account within, let's say, a big bank like Wells Fargo. So that's
so like an intermediary bank.
Yeah, kind of like that. It's kind of they're holding reserves in custody. The big bank holds reserves in custody for the smaller bank because the smaller bank doesn't have enough resources to have their own. But for the foreign banks, though, so foreign banks can have reserve accounts, and if you have like a big bank like a SocGen or a BNP or any bank that you would have heard of, they definitely have a Fed account.
But does it have to be through a subsidiary?
It has. It's usually not through a subsidiary. So it's usually they'll have a branch office in New York, and it's part of their legal entity that's, let's say, head office in Frankfurt or Paris or whatever, and they would open a branch office in New York, and that New York branch office would have a Fed account. So the way the big foreign banks work, so they're kind of like on the same footing as domestic banks. But if you're like a smaller foreign bank, like a medium-sized bank or a small foreign bank, and you also want to have, let's say, a dollar business, you would probably just have a deposit account at a big U.S. bank like Bank of New York Mellon. So in the sense that when you make a payment, you're basically sending them. If you're a small foreign bank and you're making a payment for one of your clients, you would be sending, let's say, liabilities of, let's say, a big bank like Bank of New York Mellon, and Bank of New York Mellon would then go and wire reserves to whoever the receiver is. So it's kind of like a fractional reserve banking system built upon a fractional reserve banking system. Instead of holding reserves as settlement, they will hold bank deposits of a big U.S. bank.
Yeah, so I'm following you right there. Basically, I'm trying to figure out how to explain this without the use of a whiteboard. But basically, what happens is those banks you're referring to, they have a bank account at Wells Fargo, just like you or I would.
Exactly.
And they have liabilities on their balance sheet, maybe just like you or I would, but we're a non-bank entity.
Exactly.
So when we have to transfer those liabilities to a bank, then that bank can therefore take the liabilities that were our assets in the form of dollar-denominated liabilities and send those to the bank. And then on the back end, then that reduces their liabilities, and then they have to send that major bank assets, in which case would or could be bank reserves.
Right. Two-level system.
Let's walk through how the actual balance sheets work, because if you're a non-bank and you're buying a treasury from Janet Yellen, you're going to use dollars that are a liability of, let's just say, Wells Fargo as an example. So once you do that, then Wells Fargo is going to decrease the amount in your account from $100 down to, let's just say, zero. Let's say you only have $100 in there. So that decreases Wells Fargo's liabilities by the $100, and then the treasury goes onto the asset side of your balance sheet. Well, there has to be a corresponding asset transaction. So what happens is Wells Fargo takes the $100 in bank reserves that they have in their reserve account, and then that goes down into the TGA. And then what happens is the Fed says, okay, George, you've got that $100 of worth of treasuries. We want to buy that from you. So you say, okay, Fed, I'll sell it to you. So then the treasuries go from the asset side of your balance sheet to the asset side of the Fed's balance sheet. Well, how do they pay for that? Well, they've got to pay for it with bank reserves. So they say, okay, where do you want the $100? And I say, I want it back in my Wells Fargo account. They say, no problem. So they go ahead and credit Wells Fargo's bank reserve account with an additional $100 of reserves. That's the assets, but then there needs to be an offsetting liability. So then the Fed instructs Wells Fargo to increase the amount in your account or your balance from zero back up to $100. And so now you're made whole. You're right back where you started from. There's the same amount of commercial bank liabilities. There's the same amount of assets for the commercial banking system in the form of bank reserves, but there's an additional $100 of bank reserves in the TGA. So now let's take it a step further, and stop me if I'm getting any of this wrong. But then Janet Yellen will go ahead and write out, let's say, a stimmy check to George Gammon. Let's say I didn't get any, but let's just say she writes a stimmy check to George Gammon for $100. I get that stimmy check. I deposit it with Wells Fargo. That gives them an additional $100 liability. So they take my account balance from $100 now up to $200. Well, there needs to be an offsetting asset to correspond with the increase in liability of the commercial banking system. So then those bank reserves go from the TGA into the reserve account for Wells Fargo. Now, all of a sudden, Wells Fargo has $200 in bank reserves, where they started with $100, and my account, a liability of the commercial banking system, or dollars that are circulating in the real economy, has gone from $100 to $200. Bam, M2 money supply increases.
George, that was absolutely perfect, and that's exactly what happens. And I want to be honest with you, most people in the Fed don't even understand that. So you walked through that perfectly. That's exactly what happens. It's complicated. It's a whole chain of transactions, and it is what happens.